Happy New Year. Welcome to 2025 and welcome to the first edition of the Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. The topic for the first edition of the Symmetry Spotlight is the emergency fund. And I know you may be thinking, Nick, that is not a very exciting topic. Why are you starting with that one? Reality is that building up an emergency fund is actually one of the first steps that every investor should take. And in the financial planning community, not having an emergency fund is one of the most common mistakes that we see investors make. So I think it's a pretty fitting place for us to start. Think about it. Bad things happen to the best of us, right? Car breaks down, water heater goes out, you break your toe and you have to fork out your entire insurance deductible in one day. Or worse, what if you lose your job and you can't find anything for weeks or for months? And we can't predict when these events will happen, but the one thing that we can control is having that cash reserve and that slush fund to protect us against some of these large events like this. As I said, not having the cash reserve can be a big mistake, and that's because of the damage that can come from this. Think about what could happen if you don't have that cash reserve to put away. You have to whip out the credit card and create debt for yourself, which that could carry interest rates of 20% or higher at times. Or what if you have to dip into your retirement account prematurely, which could subject you to taxes, penalties, or possibly even set you back on your goal for retirement. Or God forbid, you end up at one of those title loan companies putting your car title as collateral for some quick cash. I mean, it can get bad really quickly, and all of that can be prevented by just simply having that cash emergency fund. So how much should you put away in your emergency fund? It's a great question, not really a good kind of one size fits all answer for everyone, but I will attempt to give you one anyway. I've always spoken to the 3 to 6 month rule. So add up all your expenses for the month, mortgage, car payments, groceries, utilities, everything. And let's say for this example, it all adds up to $6,000 per month. Now multiply that by 3, voila. You now have your minimum emergency fund goal, which in this example would be $18,000. The idea is if all of a sudden your income stream were to be cut off, you want to be able to cover your bills while you figure out your next plan of action. Now, if you have steady income or a low risk job, or you work in a stable industry, then you might be comfortable just having that 3-month emergency fund. But if your income fluctuates, or you have a high risk job, or you're in a cyclical industry, maybe you want to lean closer to that 6-month target. So how many months you want to build into your cushion really just depends on your personal situation and what you're comfortable with. And if you are watching this video and currently enjoying retirement and thinking to yourself, well, Nick, I'm not working. Do I need an emergency fund? Yes, you do. It might just look a little different. You might not have as much risk of your income suddenly being turned off, but you are still subject to life's curveballs. So it makes sense to have that slush fund put away to protect against those unexpected events. Which that leads us right into some of the other factors that come into play with the emergency fund calculation. Life's curveballs. If you own a home or you drive a car or you have kids like mine who like to climb to high places and then see if they can fly, you may be at risk of having more emergencies. So a big one that I like to encourage clients to consider is your insurance deductible. You got a $7,000 insurance deductible? Might make sense to build that into your emergency fund goal. Really, just take a moment to look around, ask yourself what could go wrong, and factor in those additional expenses into your emergency fund number. So now you've got your emergency fund number calculated. Where do you put it? Traditionally, most people turn to the old-fashioned savings account or money market at the bank to store their emergency cash. Savings and money market accounts, they're liquid, they're accessible, they can be insured by the FDIC, and they can offer some interest depending on what type of interest rate environment we're in. Right now, with rates being higher, we can get some decent rates on our cash. Where do we not want to put our emergency fund? We don't want to bury it in the backyard. We don't want to stuff it under the mattress. Neither of those are going to get you any interest. We don't want to lock it up into anything that isn't easily accessible, like a CD or an annuity. And we also don't want to put our emergency fund into any investment that could risk fluctuation or loss of principal, like a stock. You don't want your 3-month emergency fund to suddenly become a 2-month emergency fund because you put it in the market, we went through a downturn. So typically the plain old boring savings accounts or money markets at the bank, those serve their purpose just fine for your emergency fund. So to wrap this up, the goal of the emergency fund is to have that cash safety net in case you have a loss of income, in case you have a life event. You don't want to have to default to whipping out the credit card and creating debt, or dipping into your retirement accounts prematurely, or subjecting yourself to any other kind of risky last-ditch effort to come up with the cash. So again, not having the emergency fund, it's one of the biggest mistakes that investors make, and I do see that play out in the real world. So if you want to kick off the new year right and check off any important financial goals, start here with the emergency fund. If you have any additional questions or you want to talk to me about what your emergency fund goal should look like, please give me a call. I'm happy to connect with you and walk through it. Otherwise, have a great month, and I will talk to you again soon.